This week, the markets caught a breather as the US and Iran reached a temporary ceasefire, sending most of the S&P 500 into a relief rally. Yet, Tesla remained a bizarre outlier, continuing a localized death spiral while nearly every other mega-cap stock turned green. Is this a standard cyclical correction, or are we witnessing the structural collapse of the Tesla narrative? To find the alpha here, we have to ask, what exactly is Tesla? Is it a maturing EV manufacturer, a frontier AI and robotics powerhouse, or a distributed energy platform? While all of the above sounds like a visionary answer, on Wall Street, a company that tries to be everything often ends up being valued as nothing. JP Morgan recently released a chillingly sober research note, valuing Tesla strictly as an automaker. Their conclusion? A price target of $145, implying another 60% downside from current levels. While Musk posts about Mars and Optimus, analysts are systematically stripping those imagination lines out of their spreadsheets, leaving behind only 3 cold metrics: deliveries, inventory, and free cash flow. My name is Phoebe, and you're watching TradingKey. When logic turns lethal, the core of the bear case isn't just that Tesla isn't selling enough cars, it's that the company's greatest strength, its extreme manufacturing efficiency, is now working against it. This is what we call efficiency backfire. Let's look at the second derivative of growth. In the first quarter of 2026, Tesla delivered 358,000 vehicles, its worst performance since mid-2022. But the real horror is the inventory gap. Tesla produced 408,000 units in the same period. That means over 50,000 vehicles are sitting in warehouses unsold. Mathematically, for every 8 cars Tesla rolls off the line, 1 becomes a non-performing asset. In a high-growth phase, a gigafactory is a money printer. But in a demand slump, these factories become massive capex treadmills. You cannot simply flip a switch and stop a gigafactory without incurring catastrophic labor and depreciation costs. Tesla is forced to keep producing, but each unsold car bleeds cash and eats up storage. JP Morgan's logic is hard to ignore. If you value Tesla as a tech firm, you're betting on a future AI that hasn't materialized. If you value it as a car company, the PE ratio is still absurdly expensive compared to Toyota or BYD, especially when pricing power is evaporating in the face of a brutal price war with Xiaomi and BYD. Blue ocean to bloodbath. For years, the energy storage business was touted as Tesla's second growth engine, a perfect hedge against a slowing EV market. But Q1 2026 data just delivered a reality check. Deployment of battery storage products dropped to 8.8 gigawatt hours, down 15.4% year over year, and nearly half of the record set in Q4. William Blair analysts noted that while grid-scale storage has cyclicality, this level of deceleration is structural. The blue ocean of energy storage has turned into a red ocean of commoditized competition. Chinese and European energy firms have caught up on density and are cutting prices to the bone. If the financial buffer provided by energy storage begins to thin, long-term institutional confidence in Tesla's platform narrative will continue to leak. This leaves Musk with only one card left to play, the AI story. Navigating the three-front war. Wall Street is currently suffering from narrative fatigue. When a company tells 4 or 5 different world-changing stories but cannot provide a clear timeline for unit-level profitability in any of them, investors start looking at the exit. Musk is currently fighting a 3-front war that will determine Tesla's fate by mid-2026. First, watch the April 22nd earnings report. Ignore the EPS headline. Look at free cash flow. If the inventory glut is strangling cash, the stock will find new lows. Second, the April 27th legal battle with OpenAI. If the trial reveals compliance or technical black boxes regarding XAI or FSD, it won't just be a PR blow. It'll become a catalyst for short sellers to attack Musk's entire ecosystem of assets. Third, the SpaceX IPO filing in June H. With a valuation nearing $2 trillion, any legal or financial contagion from Tesla could derail the SpaceX launch, creating a negative feedback loop across all Musk-led entities. In the value chain, Tesla is struggling to remain a supplier of premium tech and is being forced into the role of a distributor of discounted hardware. Until we see a margin expansion driven by FSD revenue or clear Optimus orders, this is not a buy-the-dip scenario for the faint of heart. Is the $145 target a wake-up call or just institutional noise? Are you holding the line on the AI vision, or is the manufacturing reality too loud to ignore? Let me know your thoughts in the comments down below. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.